Hello, everyone, and welcome back to Multifamily Talks Live. I'm your host, Krista Hurley, and I'm thrilled to be joined today by two of our top market experts, Whitaker, Chief Economist, and Dustin Weaver, Market Research Analyst. Multifamily Talks Live is a monthly LinkedIn series featuring candid, bite-sized conversations on all things multifamily. If you missed the live session, catch the replay on your favorite podcast platform. And don't forget to follow us on LinkedIn for updates, and please drop your questions for our guests in the comments. Today, we'll recap the biggest trends and takeaways from 2025 and share insights on what you can expect in 26 across the multifamily landscape. So let's dive in. Thanks, guys, for joining us. Carl, can you start by telling our listeners a little bit about yourself?
Yeah, for sure. Be happy to. Whitaker, Chief Economist here at RealPage. I have the honor and privilege of leading our team of market analysts and our team of economists who stay abreast on market trends, industry trends, and we like to dive into the data.
Perfect. Dustin, what about you?
Yeah, so Dustin Weaver, Market Research Analyst here at RealPage. RealPage working with Carl, diving into the data. Really all it means is I'm just a data nerd that likes to talk to people, so.
It's perfect, perfect. Awesome, well thanks for joining. Now let's rewind the tape a bit. 2025 was a wild ride for multifamily, and some things that we expected and some things we definitely didn't. So let's start right there. What were the biggest surprises in the multifamily market during 25 that operators did not see coming?
Yeah, for sure. It's been a big topic of discussion being at the end of the year. And by the way, just kind of a quick note, we did, in fact, host our RealPage year in review yesterday, as a matter of fact. So you can register for that at realpage.com/webcast. But one of the key themes we honed in on in that discussion was the fact that retention continued to increase throughout the year. And I think we were very surprised by that. But we went into the year thinking that retention maybe wouldn't decline significantly, but probably wouldn't incline either. But it did, in fact, increase. So I think that was probably one of the biggest surprises.
Yeah, absolutely. I think to kind of add on that, I think in addition to retention levels growing as much as they did, I think the increase in concession uses that we're starting to see, they've been pretty prevalent the last couple of years, all the supply, but, we're starting to see an increase of that, I think, kind of in tandem with some of the economic uncertainty and then retention focus as well.
Yep.
Awesome. So which trends from 25 have the most significant impact on rent growth and occupancy rates?
Yeah, and I'll actually pepper in something that kind of ties into the retention point. Was that I think one of the biggest trends that influenced rent growth and occupancy, and therefore retention, was the growing economic uncertainty that we saw unfold throughout the year. We went into the first quarter, the labor market was still in relatively good shape. There were some headwinds emerging, but as the year went on, we saw that consumer confidence really started to plummet and the labor market started to really lose some steam. In other words, job growth really started to slow down. I think those were the two big things that affected demand. Therefore, that affected rent growth and occupancy, because all the while we had a supply overhang. That was always going to be the case going into 2025, but the case for the demand thesis really started to come undone a little bit. Now, it wasn't a significant undoing of demand. I do want to just make note of that real quick, that it wasn't like demand totally evaporated. It just didn't measure up to what our expectations were.
Yeah, I think it's more, you and I have talked about this, ad nauseum probably, and that, it's more that I think both the demand side of the story, that the new residents, new renters, they kind of hit pause on making larger financial decisions like housing. And I think also on the other side, it's important to note that I think a lot of businesses, operators, also kind of hit pause on, hey, let's focus on stability and getting our occupancy where we want it, because we're still not quite sure what's going to happen tomorrow. And that's what we've seen kind of play out this year.
Yeah.
Totally.
So how did supply and demand dynamics play out compared to early year forecasts? I know that we met last year in Multifamily Talks around this time talking about that topic.
Yeah, almost to the week. I was looking at the date the other day. I think it was December 16th last year.
Wow, that's crazy.
So it was almost to the week. It was funny because we looked at our March data a couple of months ago, and up through March and maybe even April, our expectation for the year was actually pretty close to what we thought would happen. Demand was strong. Supply would be a headwind in some markets, not everywhere, however. And we actually saw that rent growth was seeing a little bit of momentum relative to 2024. Not significant, but there was at least a little bit of momentum bubbling up there. April, May, June come about, and we really saw that the labor market again started to slow down. So I think the short-ish answer was that the first 90 days of the year played out very close to our expectations, but then the subsequent subsequent months started to underperform expectations because, again, that demand side of the equation just didn't get quite the umph that we had all thought.
As economists and market research, is that validating when that happens? You're like, I'm predicting
It is nice
this.
to be like, yeah, hey.
It is indeed, yeah, and it's funny because it's, you know, I think about, I often think in sports terms, and it's a lot like, you know, somebody that focuses more on their strikeouts than they do their successes,
Right?
you know.
Yeah.
But it's good because it is helpful to calibrate these things along the way. But yeah, it is selfishly validating when things do play out like you expected.
I love it. So when we talk about regional markets that outperformed or underperformed, where were those expectations and why for 25?
Yeah, so the outperformers, I think nationally, and Dustin, feel free to chime in here too if you feel any differently, but outperformers were the Bay Area, specifically San Francisco. I think that's a case in point example of a market that didn't see those demand headwinds because that's the epicenter, if you will, for the AI tech renaissance, for lack of a better term. So the Bay Area outperformed expectations. We saw that the Sun Belt really started to I'm going to sound like a broken record here, but the Sun Belt really started to trail as job growth slowed down. But again, the reason there being was that supply doesn't get absorbed overnight, and it's taken a little bit longer of a runway to work through all that supply. I think another interesting tidbit that kind of unfolded throughout the year was how the impact of slowing international migration really impacted certain markets, but especially certain product types within certain markets.
Yep.
We saw Class C vacancy started to rise faster than expected in a number of instances. We started to see more of kind of a shadow market impact there. And I think a lot of that was because the international migration flows have basically come to a halt. Now, that was true in some other markets as well, not just the Sun Belt. And I'll point to Boston as a good example of a market where I think international migration, particularly for students who attend those local universities, but also the affiliated research jobs that are supported by those universities, that really kind of pulled the plug on demand in the Boston market too. So it wasn't just a Sunbelt specific phenomenon, but I think that was more of the more common instance.
Yeah, absolutely. And I think one of the other interesting things that we've seen this year has been kind of that inversion of the urban-suburban relationship. And it kind of ties to what you were saying about San Francisco, the Bay Area, where, you know, we're seeing kind of resurgence and increased urban demand compared to what it was maybe a few years ago, that relationship between urban, suburban, occupancy and demand. And it just really kind of speaks to further complexities within the rental space and the multifamily market, you know, today compared to, you know, what we saw last year or the year before.
Further complexities, that's a great way to, that's a great byline. Further complexities, 2026.
Got to keep everybody on their toes, right? Surprise.
All right, well, let's shift gears and talk about what's next. So if 25 taught us anything, it's that the market can surprise us, right? And we still need a roadmap. So let's grab those predictions. What are your top predictions for rent growth and occupancy in 26?
Yeah, Dustin, I don't know if you intentionally did this or just kind of by nature of being good at your job, but you segued well into my answer, which I think is the urban type profile of market. I think will outperform in 2026. A lot of that driven by return to office, you know, demand's kind of getting pulled back closer to the urban core. But it's not necessarily just the dense urban core. It's the markets where big HQ style employment is important. You know, the Bostons of the New Yorks of the world, the Chicagos of the world, the Seattles of the world. And then bonus points, of course, if there is any sort of AI kind of double bonus, if you will, in those markets. I guess perhaps stated more succinctly, areas that demand will exceed supply, largely those coastal markets, the big urban markets, and a lot of that because it's harder to deliver new inventory in those places too.
Yeah,
absolutely. And I think we'll continue to see, you know, maybe to the surprise of some, but not everybody, the Midwest continue to outperform, so to speak. Kind of, you know, to build on that, absolutely, you know, those are areas where we're still continuing to see more demand than supply. They really, you know, have continued to live up to that slow and steady moniker, you know, so to speak. And when I say outperform, I don't mean, you know, 5-10%, you know, rent momentum, rent change year over year. It's just that simply that consistent 2 to 3% continues to put them at the top of the leaderboard. And I think we'll continue to see that in the next year, maybe even in 2027, you know, as we move forward.
Yeah, it's very important for our operators to listen in on those markets to really better understand and position themselves almost from a strategy standpoint for adopting tools that can help with driving that demand for that lean supply. So how will macroeconomics factor here, like the interest rates or job growth? I know you mentioned that earlier, Carl, shape the multifamily performance in 26.
Yeah, I mean, macroeconomics is the tail that wags the proverbial dog, if you will. I think it is what really ultimately drives not only apartment demand, but investment in investment in the space and where properties are being bought and sold and why they're being bought and sold or how they're being bought and sold even. I think for 2026, the biggest unknown is job growth. If job growth gets back on track, which by the way, the most recent economic data release shows that there's maybe some glimmers of hope starting to emerge. It's a small silver lining, but it is a silver lining that we're maybe starting to see some positive movement. If that does then filter into job growth, then we see demand improve. Conversely, if that doesn't improve, then demand could face more of a shortfall relative to supply, and that would then further prolong the recovery timeline in the Sun Belt. I still think the Sun Belt, you're going to start to see some areas that do get a little bit of movement next year, but it may just take a tiny bit longer for all of the markets to move in unison. The last thing I'll mention too, macroeconomic wise, is all eyes are going to be on the Fed and their decision on rate cuts. I think we'll expect one in, I believe it's today's meeting. A cut is expected going into next year. I think we'll see likely 2 is kind of the broader thesis right now. And really where that will become important is if rate cuts do materialize, does that actually start welcoming more investment activity back into the space? Do you see more apartments trading hands? Because the investor appetite has been and remains quite robust. It's just the market's been on a little bit of a diet right now, if you will, knowing that interest rates have been a bit prohibitive.
Oh, I would love that for multifamily.
Absolutely. And I think kind of building on the macro economy and the jobs and everything there, we've seen it kind of slow the front door demand, right? Retention's been strong, occupancy been relatively stable. But I think the other side, something that's been top of mind for me, and I'm sure many operators as well, is concessions. Right, how does this play into that? The concessions burning off, which is everybody's kind of waiting for that moment of when we get back to more normalcy and not necessarily needing to offer incentives because there's so much new supply out there. So I think that's also going to kind of dictate that pricing momentum and the occupancy momentum as well of when can we start seeing concessions burn off as we move into the future. Yeah,
something to look out for. So we actually had a comment. Thank you, Kim Kazaka. Great name. Realtor at White Fruit Property Partners. This is valuable info. Thank you.
Awesome.
So I love
Thank you for joining us.
Thanks, Kim.
Love it.
Awesome. So are there any emerging markets or regions that investors should keep an eye on as we spoke about that area?
Yeah, you've probably heard the saying before, skate to where the puck's going to be, not where it's currently at, and I think this answer maybe feels a little bit at risk of doing that, but Dustin prefaced it well, where I think the Midwest has kind of proven its investment thesis of that stability. You even talked about portfolio management and kind of how you round out a portfolio. I think of the Midwest in some ways as having, bonds in your 401k, for example. It's nice to have that 2 to 3% return in a given year, knowing that you may get 10% on a higher volatility stock, but you may also get a 10% loss if it's, I'm going to pick on Tesla as a stock, just for example. So you want a nice rounded portfolio, and I think the Midwest has kind of proven again that investment thesis this cycle. And with that, it's actually kind of helped remove one of the biggest headwinds that was previously in the Midwest, was that a lot of investment activity didn't necessarily seek to going there. So you had a little bit less liquidity. It was like, sure, you could buy the property, but who are you ultimately going to sell it to afterwards? How are you going to close that exit strategy? Now that's becoming a little bit more of an appealing investment thesis. I think another area that I'd keep an eye on next year would be some of these hard-hit Sunbelt markets, the Austins of the world, the Jacksonvilles, Tampa, Raleigh, Durham. If those markets can see demand catch back up to supply, which, by the way, it will happen at some point, but the pace at which that happens is kind of the big unknown. I think now, though, we're starting to see one of the knowns in that equation, how fast supply is pulling back. Again, it won't get absorbed overnight, but the pace at which the catch-up effect, I suppose, that's needed at this point is a lot less significant than it was, say, this time last year.
Yeah, absolutely. And I think to that point, I know there's a lot of headwinds around supply right now, especially in the Sun Belt. But to your point, demand will catch up to supply if it hasn't already in many areas. And supply is continuing to fall and fall quickly. Construction's falling quickly. We're not seeing starts turnover to take place, backfill
really
the number of units we're seeing. So it's very challenging, but I think longer term, there's still a lot to like about the Sun Belt. And so I think there's a lot of opportunity in those metros in the future, because, as we've seen in the last few years, all that immigration, all that demand, the population movement has been very concentrated in the Sun Belt. Not that we haven't seen it elsewhere, there. But I think that's also a strong argument for a continued thesis of looking at those Austins, the Tampas, the Dallases. I swear we're not biased or living in North Texas, but I think there's lots of like.
Hey, you guys mentioned Raleigh, Durham, and I'm in Greenville, South Carolina. I'm hearing a lot about the Carolinas lately. So, but shifting gears just a smidge, what role will affordability challenges play in shaping demand and pricing strategies? It has been a hot topic this year.
Yeah, I mean, it was even the hot topic in the elections, and we've seen it come up politically. It has been understandably and rightfully so a hot topic. I'll actually take the angle of single-family affordability and how I think that's influencing rental housing trends. Single-family homes, the cost of ownership has gone up so significantly, especially relative to rents, that it has made it challenging for moving into single-family homes. I think another thing to mention there too is that we are starting to see some positive movement in home affordability, but it's at the high end of the price spectrum. It's newer builds. It's not necessarily your starter home inventory, if you will. So with that, I think we've seen some demand kind of pinned into the Class A sector for longer. And on the rental side of the equation specifically, I think kind of an untold strength in the market is we're actually seeing rent-to-income ratios improve a little bit as well, particularly in Class C inventory, which has seen 2 straight years now of rent declines while wages have grown positively in that segment of the market too.
Yeah, and it's not to say that there's not affordability challenges out in the rental space, because there absolutely are, right? Inflation's up, over the last few years cumulatively quite a bit. But when we look at our data for the, what our niche, which is really like that market rate rental space, right? Rent to income ratios are down to their lowest levels that they've been since I think 2018 or 2019 now.
Yeah, sounds right.
And it's across the spectrum. It's not just Class A or B, it's Class C. As wages have outpaced, wage growth has outpaced rent growth for I think 3 years now. I can't believe it's been 3 years, but 3 years now. So it may seem kind of counter to it, but at least when it comes to the market rate rental space, residents are spending less of their wallet on rent than they were, which I think has given some ability to go out and get into this new product that maybe we didn't see a few years ago. Things like filtering, people moving up the pricing spectrum. So
it builds that confidence.
Right, totally. And I think another thing to mention there real quickly, I'll piggyback on that, is just that the financial situation of the standard market rate renter is actually in economically pretty good shape. But like Dustin said, we don't want to paint with so broad of a brush to say that, hey, that's true ubiquitously in the market.
The board,
It's not.
Yeah. So shifting gears to one of my favorite topics, AI. What impact do you think AI could drive in analytics in identifying those emerging markets or risk factors that we've been talking about thus far?
For sure. Well, I'll start with a kind of a joking quip by saying that I hope AI doesn't put me out of a job. But and I genuinely don't think that. We'll get into the merits of that here in a little bit. But what's really surprised me with AI, and I think that it's going to only accelerate from here, I've been really surprised at how fast it's gone from that's a cool thing that it can do to, holy smokes, it can do what?
Yeah.
And I think as we see that happening more and more, we're going to see it become more widespread, more widely adopted in the space. We're going to see it more widely utilized and more intelligently utilized, because right now it's oftentimes a cool tool to use, but we're not quite sure where it fits in the stack and how to utilize it. So I think that that's important to note. And I've said this a couple times, I'll say it here again, that kind of jokingly but somewhat serious, that by not adopting and adapting to AI right now, you're quickly positioning yourself to be a user of a fax machine in a world where everybody else is using the internet.
Yes.
You don't use a fax machine?
Yeah.
No, I think that's a great point. We're still in this period of figuring it out, right? It's a cool new tool, but it's not 100%, definitive. Here's how you use it, right? We're still kind of figuring that out, a lot of trial and error. But I think the big win, especially in our industry, when it comes to, deal volume and momentum and stuff like that, is going to be, increasing efficiency and being able to churn through more data and more analysis quicker. I think, that human component still has to be involved, but I think that's where we're going to start seeing the biggest benefits as we move forward, is it kind of on the efficiency, time to value type.
Yeah, exactly. I mean, most of the agents that we launched this year at our annual event, Real World, highlight that exactly. The hours saved that AI can do for the site teams to repurpose to more valuable, rewarding things for those renters. So do you think that AI will accelerate decision making for developers and investors in 26? And if so, how or why?
Yeah, I actually think this is going to be one of the more clear-cut use cases for AI. Now, granted, I'm usually working with folks on that side of the business, so I kind of hear a little bit more about it. But I was talking to a group up in Michigan a couple weeks ago that said that what they've done in the past 6 months even is they've looked through 100 deals from an underwriting perspective that historically would have taken them twice that long, if not longer. They still have the same number of analysts in-house that are looking at this. It's just they're able to get through more deals. They're able to get through more properties. And beyond that, the 5 deals that end up making it to the C level for those final decisions, that is better vetted, so it's like you're focusing, like you said, more time and effort on things that are higher value. You're not kind of bogged down in the minutia. I do think that, in terms of site selection and figuring out where to go, I think AI has some early potential capabilities, but I think it'll be a little bit later in the development cycle before we see that use case really starting to unfold. But again, there's going to be groups out there that find that shortcut sooner rather than later, and they're going to get ahead of their competition by nature of adapting and adopting those tools.
Yeah, absolutely. I think it absolutely will accelerate, that side of the industry because, in my opinion, kind of what I've seen the last few years, we've been in such a furious pace of evolution in the industry for both, the business side, but also the resident side. But what the trend I'm seeing come out of this is it's more so about the small levers that you can pull to get ahead than it is the bigger levers, And for me, AI is one of those things. I think the trick is being able to figure out how to leverage AI in an efficient way, not just going, hey, we're going to use AI, so use it and then figure it out, but actually sitting down and going, okay, this is some areas of maybe inefficiency or areas of opportunity. Maybe we can leverage this in here to not to keep the same group there, but help them work faster paced to get ahead of others because deals are moving so quick because they're so far and few between right now.
Yeah.
Strategy versus tactics.
Exactly.
Absolutely.
Yeah. So do you anticipate any changes in renter behavior or preferences that operators can prepare for?
Yeah, it's a good question. And I think that there probably will be some things, a lot of things we don't yet know. And I wish I did know the answer to that because I would have some good ideas if I knew what the answer was. But I kind of think it would be interesting to go back, for example, and look at conference agendas back in 2017, 2018, see what the agendas were focused on versus what they are now. And I imagine that it's vastly different in terms of that industry evolution that y'all are talking about. I do think that maybe the biggest shift in renter preferences isn't actually going to be when folks are on site, but it's how residents get to those sites.
Yeah.
And
Great point.
I think about back in the day, you would see a banner on the side of a building that said, leasing now, call number, blah, 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 blah.
Right.
How many 20-year-olds, how many Gen Z folks are calling a number on the side of a building to inquire about availability at that property? They're not. They may not even be using Google now. They may be dropping it into ChatGPT and say, I want a 2-bedroom, 1,200 square foot apartment. It needs to be close to bars and nightlife, but I can't be further than 20 minutes away from work, and help me return properties that are offering a 2-month free concession.
Right.
Well, lo and behold, you get 5 properties spit out in that, or 10, or whatever the parameters are. So I think the ability and how residents are searching for those properties is going to be one of the biggest preference shifts. On top of that, I think it's going to further the importance and the magnitude at which management companies and operators are able to deliver upon their promises of offering a quality resident experience. Now, that's harder to qualitatively measure or quantitatively measure, I suppose, but qualitatively, I think that that's a big shift.
Yeah, and I'm glad that you hit on that because I rented for more than 2 decades, right? And to your point, what it was like trying to rent an apartment in the 2010s to where we are today is night and day different, right? Back then, properties not having websites, you couldn't find any information, you had to call or visit them, right? And today you can do digital tours, you don't have to be in place, you can get all of your information, literally everything you need to do. You can sign the application online and never step foot in the office if you want to.
Agreed.
And I think that is indicative of how renter preferences have changed. But I think the qualitative side of things are even more important than maybe they were forever ago as well, right? The simple fact remains we've added more than 1.5 million units in the last 3 years. There's more options for renters to choose from than ever before, which means if you don't have that information out there, or they have more information to look at. So the qualitative components, the reviews, the opinions of the pictures, all of that, the interactions with the staff, right?
Right.
If you don't deliver on your promise, they've got 20 other properties they can call that are probably priced very similar and have the same amenities, right? So it really comes down to that qualitative component of being able to set yourself apart, deliver on your promises, and make the renting environment and renting feel fun and not a nightmare.
Right.
like maybe some of us remember from years ago.
What What about you, Krista, though? Let me play interviewer here for a minute, if you will. You're closer to a lot of operators than Dustin and I are, a little bit more close to asset management and stuff. What are some things that you're hearing on this?
On the AI side, it is they're riding that wave, right? They really want to lean into having the tools available that they can trust, number one, and that the teams can really glean those insights of hours saved, or it was able to execute this task, and see that in a qualitative manner to really make those business decisions better down the line. And so adopting AI is something that I don't think that it's a question anymore. It's you are doing it, but how are you doing it, and what tools are you putting in place to ensure the success of your business?
Makes sense.
I love that you just flipped the script on me, Carl. That was awesome. We got some friendly comments. I'm super excited about this. So Kim Kazaka, again, she came back and said, houses are priced that are too high won't sell. People would rather have an easier transition and choose multifamily, especially when new to an area. Not everyone wants the drive, distance, and hassle of home ownership. Multifamily is a turnkey solution and gives them time to plan for home purchasing in the future. I love that.
And I think, just going back to renter preferences as well, I love that comment. Renting, I don't think has the stigma that it did, 10 or 20 years ago.
Yeah.
I think there's a lot of folks, we can't ignore, what's happening on the single family side of things and the pricing there and the affordability there. But I think given the option, I think a lot of people are choosing to continue to rent because they're able to access amenities and a lifestyle that you can't if you were to purchase a home, depending on where you are. So it's just a very interesting time for the industry overall.
I'm also a nerd at heart, and I think in terms of if I'm renting for, call it $500 a month less than single family ownership, and I'm making up a number, don't quote me on that. Let's say $500 a month difference. Well, that's $500 you could put into some sort of investment account. On top of that, you're not paying for homeowners insurance. You're not paying for the cost of repairs. You're not paying for somebody to go put your Christmas lights on and yard work. Well, by the time you bundle all that cost of ownership together, that's, maybe $1,500 a month that you could have put into some sort of investment account that is accruing theoretically 7% per year. So if you do that for 10 years, you could actually pay for a house at age 40 maybe with cash, and obviously I'm oversimplifying some of the assumptions there, but I think that there's a growing contingent of people that actually are looking at the world through that lens.
Or even like the pick up and leave mentality, right? Like COVID kept us so isolated, and we were stuck for so long that when the world opened back up, it was, I got to go travel. I got to see cities that I've never seen before. I got to live my life.
With remote work, I can move to another city and experience life there where I'm not tied down, if I were, own something at that point in time.
Yeah.
Absolutely.
All right, we have Cameron Gonzalez, data storyteller from Business Analyst at...
How did I get that title?
I know, I love that.
I love that.
From Concord Rents. What do you think demand will look like in 26 for rent-controlled apartments?
Yeah, that's a good point. I think the demand is always there. There's a reason that there's a reason that the cities that leverage rent control are doing that, and it's because there is a huge depth of demand for rental housing in those markets. Now, unfortunately, that may not be the best way to go about the situation, and I won't opine too much on this, but I think that solving the supply challenge is a better way than effectively solving or subsidizing the demand side of the equation. But I think the demand in that segment of the market is strong. I think it will remain strong. I do think that there are some instances of markets where, again, maybe the combination, as Dustin mentioned, of supply being robust enough while also seeing slowing migration into those markets, both international and domestic, by the way. I think that you could see a little bit of a disconnect there in terms of demand and supply, but for some of those cities that are leveraging rent control, again, the demand is certainly there for housing of all types, by the way, not just rental, housing of all types.
Right. That's great. Then we have Kim, and excuse me if I butcher your name, Guin, Regional Marketing Director at Willowbridge Property Company. You've touched on factors that affected Class A and C assets and performance. How was the performance of Class B assets, and what are some of the factors that could have led to how Class B performed? And bonus points for Class B in suburban markets.
Ooh, that's fun. I love that question.
Do you want to chime in first?
This one has been kind of near and dear. We
were talking about.
We love this topic, by the way. So thank you for reading our minds. I'll put it. I think Class B's. The challenges in the Class B space that they've been kind of stuck in the middle. right? You know, in your your Midwest, your Northeast, your gateways, not as much of challenges there because you're not really seeing the supply. But in like the Sun Belt, there's been so much supply that we've actually seen that impact Class B and C more than we ever have before. You know, and so that's led to these instances where in many Sun Belt metros where we're seeing this record supply, Class A is actually doing A-okay, you know, not necessarily, you know, super strong, but, you know, we're seeing positive momentum there. Yeah. Whereas your Class B, you know, the new lease up average rent pricing is so close to the average Class B rent that Class B renters can just step into that new product and get, you know, 2 months, 3 months free concessions. And now Class B is going, okay, well, how do we stabilize our occupancy? And so they're having to offer more concessions where, you know, when you think about supply historically, Class B never really felt any of that impact. It was Class A.
Right.
You know, so I think Class B performance is doing okay, all things considered, but there's still there's some softness there that you know, we don't typically see in higher supply periods like we would looking back historically.
Right.
Nice.
Yeah, I think the big thing for 2026 in particular is that in 25, one of the big unexpected headwinds we saw was that many of the economic sectors that support Class B housing most closely, that was the biggest slowdown in the market. You know, you think about education and healthcare jobs, that really started to see a lot of headwinds. Just one economic sector, for example. So that slowed the demand side of that equation. But I do think that at some point, sooner rather than later, the demand and the supply story for that Class B segment of the market, that supply-demand balance starts to create a much more favorable story, much like we saw 2015, 2016, 2017, when all the investment was really kind of, I shouldn't say all, but a lot of the investment was targeting that segment of the market. There's a big need for it. There's a big demand pull for it. And I think eventually that levels out.
Absolutely. And I'll add, you know, she mentioned suburban specifically. Here's a fun or maybe not so fun fact is that when we look at inventory growth over the last couple of years, urban versus suburban, urban, you know, ended up back kind of where it was historically, around 4% inventory growth. Suburban areas actually doubled their historic average inventory growth. Or another way of saying it is suburban areas, which is going to include a lot of those Class B assets, saw double the inventory growth than it's ever seen historically. And so that just put that additional pressure, especially in the suburbs, where you normally don't feel that. Normally in the past, most of that supply is in the urban core, so your suburbs, your Class B assets out there aren't really feeling it, and that's changed where we are today.
Kim really got you going on that question, guys. I love it.
We'll
Thanks
go for
so much.
We'll do a full webcast on that topic.
Okay, so Cameron, the data storyteller, he came back and asked, do resident wants to see more AI integration? For example, do the residents appreciate tools like AI call center representatives? This is definitely my question.
I was going to say, that's right up your alley.
Yes. Thank you, Cameron. So we've done a lot of renter preferences studies, and we have found that over 70% of them actually want a digital experience with their on-site team members. And so, you know, feeding into those AI tools to have that digital experience with them to very quick click, right? Because residents want and need it now. So meet them where they're seeking that. You know, we do have AI now for voice for residents to be able to engage with an AI representative in our markets. And so, yeah, we're still a human touch, and there is that human in the loop that happens. But yes, we are seeing that residents want to engage with AI more so than ever before. So thank you guys so much for joining, and thank you to our audience for joining Multifamily Talks throughout 25. It's been an incredible year of insights and collaboration, and we're so excited to keep the momentum going. Planning for 2026 is already underway, with one session per month continuing next year. And our first talk of 26 will kick off in late January, and we'll start the year strong with topics like AI strategies, resident expectations, and marketing trends. So thanks so much for joining us, and have a great and safe holiday season. We'll see you in 26.